We've talked the past few weeks about those June highs and whether or not it would be resistance. S&P managed to blow through that, and now the conversation's turning to narrow breadth, especially in the NASDAQ. How are you thinking about this, and does it remind you of February of 2000?
Well, David cited a very interesting thing about the S&P advancing more than 5% and then still having 8 of its components closed down, and that had only happened back in February of 2000, which for those of us old fogies who have been around through that recall to have been pretty much part of the blow-up in the NASDAQ.com bubble, and it got painful after. So those reminders, if you would, of the look of blow-up, the NASDAQ with the massive amounts of buying that we saw in things like Amazon with the upgrade and Tesla and a variety of others have a kind of frothy impact. And, veteran traders look at that and say, maybe not time to ring a bell yet, but certainly time to be wary. So for now, the market is in great shape. As Jim Paulson pointed out early in the week, there's a massive amount of stimulative support for the market from the government, the M2 versus the GDP at the nearly historic levels, certainly better than it was at the bottom of several other recessions. So on the one side, we've got a lot of underlying support for the economy and for the market. And on the other side, that those hints of frothiness do worry old traders. So we're going to watch the next 2 weeks very, very carefully, Carl, particularly at the internal technicals of the market.
Yeah, I want to get you on the tactical moves here and what the end of July means and all of that. But longer term, Art, you mentioned M2 growth, Fed balance sheet. We're going to do another $1 trillion, which seems tame compared to the prior stimulus packages. If we get all of that, plus the vaccine, what does that mean for asset prices? And do you think that gold and silver are accurately reflecting concerns about inflation?
Well, the gold and silver move are partially concerned about inflation. That the enormous growth in the money supply historically would be inflationary. It's something people worried about back when Bernanke and the Fed started pumping money into the system. What has happened during all this, however, is that there's been no velocity of money. To get inflation, people have to lend it or spend it. And so far, the assets are resting in bank vaults and in other places. It's bullish in the sense that it's additional funds that are waiting to be placed, and therefore that's reasonably good for the market. But if you watch and velocity begins to pick up, that could lead to a little bit of a burst in inflation, which nobody wants to see. So there are some warning signals out there. For now, the underlying amount of built-in stimulus is helpful. This morning, there's a little bit of a pause in the market as we're worried about whether McConnell can get the new stimulus package through that you referred to. So it's hesitant. And some of the China tensions with the closing of the Houston consulate. So cross currents as usual on the market. The cycles indicate, as you noted, the end of July often has a mild topping process. No sign of it yet, and the technicals will be watching to see if the NASDAQ can get above 10,850, 10,870, and that would let it join the S&P in moving toward newer highs.